We're going to talk about the bond market first, and grateful to have with us here a man who needs no introduction. One Tom Keene, of course, the co-anchor of Bloomberg Surveillance, Bloomberg Money as well. Tony Crescenzi joins us as well, portfolio manager at PIMCO. Tony, let me start with you. I just want to get your perspective here. It's been a couple of days since we had the surprise intervention by the Treasury Secretary announcing these changes to the bond buyback program. How are you processing it? How are you thinking about it? What does it signal about Mr. Bessent's approach here to stewarding the U.S. economy?
Well, it's a stabilizer is probably the best way to think about it. And when we think as investors about what to do, we have to really start with the principle of how to invest and what the fair value is. So how do you determine where a 10-year note should be, where a 30-year bond should be? What does a bond investor actually think? You know, there are a lot of headlines, but we have to still do the math. Think of the movie The Martian, remember? He said, just get to work and do the math. There's really three components of a bond yield that an investor thinks about each and every day. And we're focusing a lot on, of course, on this technical operation. But the most important variable in that, and I'll go through each one really quickly, is the inflation component. It's the least variable when we think about what we should be compensated against as investors in a long-term security, because you are in it for a while, 10-year, 30-year period. A 2.5 is pretty reasonable if you think the Federal Reserve is serious about inflation. We're using something like the low twos in our systems, even though the Fed has a 2% inflation target. Now, I said just a second ago that's the most predictable component of the compensation a bond investor demands when buying a bond. That may seem difficult to imagine these days because inflation has been moving around, but it has been more stable. In the old Greenspan, the former Fed chair, and Volcker, also the former Fed chair, who conquered inflation in the 70s, their old way of determining whether or not the inflation story was in the right place was to think about whether prices were stable, whether they had achieved price stability. There was no number. The Fed established a number under Chair Bernanke in 2012, the 2% inflation target that Kevin Warsh is focused on now. They had a way of thinking about it, and they both said it, Greenspan and Volcker, the same way. They said price stability occurs when price changes cease to influence household and business decision-making. Now, could we say that about the past few years? Probably, because the economy has been pretty good. Look at the stock market. It's been roaring. So that part of it looks pretty good. And I'll go through those others two in 30 seconds. We have the neutral rate. How do you know whether you're at neutral? We'd say that's about 1 point over the inflation rate. How do you know that that's the neutral rate? Maybe it's 2 points. Well, the economy has slowed over time with the Fed's current 3.5-ish policy rate, which suggests that number is probably right. So around 1 point you want for the neutral rate, the real neutral rate, 2.5-ish for inflation compensation. But the tricky one, the one you're talking about, and everyone is this week, is the uncertainty element, the term premium, the extra yield you get for the uncertainties about many, many things. It's a catch-all. And we'd say that should be around 1% now. Yeah. So that adds up to something like 4s. And so we're kind of in the fair value zone.
Well, there's
Tony, knowing his audience, by the way, I know you're a huge Martian fan of The Martian, so I just
listen. I followed that. However, there are fewer things I hate more than doing the math, and I'm now adding talking bonds to that list. Okay. All right, Tom. Help me understand what Bessent said, because the Treasury Secretary said in an interview with CNBC, we believe that yields don't reflect the underlying fundamentals. How can that be? David Gura says I should be astonished by that.
I've been doing this for 124 years.
Yeah. He's rounding down. He's rounding down.
Longer than Crescenzi. I have never seen a pile-on like this weekend in the zeitgeist on the Treasury Secretary of the United States of America. Just as one example, Lars Christensen out of Copenhagen with Danske Bank, hugely respected even by people that disagree with his economics, was vicious in a lengthy message this morning about the Treasury Secretary, and there's others as well.
Vicious about the action he took, about his messaging on it?
It's about the arrogance of it. In Chairman Warsh's defense, he's got to now completely adjust the body language at Jackson Hole to remove himself from what is perceived by the street, by economists, by finance people, is the arrogance that we saw this week. I'm not saying it was arrogance. I'm saying that's clearly the opinion, David, that we see now.
We had Crescenzi on the show yesterday, Tom, and he said he'd love to be a fly on the wall at the weekly breakfast that the Treasury Secretary and the Fed chair have. As I say, we're going to talk about Jackson Hole a little later in the show in more detail, but talk a bit about that. I mean, we see a Treasury Secretary now, Tom, engaged in yield management, which customarily, historically, traditionally has been the provenance of the Federal Reserve Chairman.
Well, they're two different things, but the basic idea is the Fed is independent, and we still have that independence. I think the check here at Jackson Hole and the check here right now as we staggered a Monday morning, or frankly, Monday morning in Tokyo when they open in Japan, the check is the markets will corral the Treasury Secretary. They don't have to corral the Fed. The Fed is an independent body, and it's still proven is an independent body. I would suggest the great unspoken here now, and also to get to next Friday and beyond, the great unspoken here are the governors and the presidents of the Fed have a voice. It'll be fascinating to see the body language in the next meeting, the meeting after that, even the post-election meeting. It'll be fascinating to see how the presidents and the governors respond to Besant and Warsh.
Tony, one of the other things I dislike intensely is that I am now the person at dinner parties who talks about things like bonds and the Fed, and it makes me
lucky you.
It makes me very uncomfortable. However, I was out last night. I was asked by somebody, and they said, "Oh, well, you know, I don't care about this bond stuff. I'm not invested in bonds." But we're all kind of invested in bonds, right? Because they are this paragon of stability for so long. And looking what happened at this last week, does it make you look at the U.S. bond market any differently? This is not a place you're supposed to see frequent surprises. Frankly, it shouldn't be interesting enough for us to be leading this hour
or to come up at dinner parties.
Well, you know, I'm not saying my dinner parties are barn burner, but you can all attend for yourselves and let me know.
Well, it's important right now. Investors have an opportunity, and they should be thinking about it this way. I like to call it the double, to join what I call the double lock club. Americans are very astute when mortgage rates decline to lock in low mortgage rates for 30-year period. They could be just as astute now if they believe that there's value in the bond market in locking in higher interest rates because on the interest that they receive. Because today, these days, in high-quality bonds and in portfolios, what I mean is a AA type portfolio, you could earn between 5 and 7% or so. AA means historically, according to the rating agencies, 99.98% chance of getting your money back. So the value proposition still is quite good. And to Tom's point, the Fed presidents, the Fed governors, they are part of a contingent that for 40 years has protected the bond investor against the ravages of inflation, the key nemesis of the bond market. And I'm reminded of a story I read in the Fed's oral history project of the early 2000s, an interview with Nancy Teeters, who joined the Fed in the late 1970s. She joined when G. William Miller was Fed chair for about a year or so. He was outvoted, by the way, at a couple of Fed meetings. She said that he thought he could do whatever he wanted. Yeah. He didn't realize he had to go through us. And so that's the way it's shaping up. One quick thing, Tom. One question we might have going forward is, will the Fed become, and I doubt it, a Bank of England styled governance where the Fed chair is in the minority?
Exactly.
It's possible, but I wouldn't.
It's amazing.
Put my money on that.
Crescenzi's brilliant on a Saturday. I don't know how he does that.
Sunday.
The heart of the matter is,
it's even more impressive.
Not to turn this into a history lesson. I don't want to ruin.
The only other person who's read the oral history of the Federal Reserve besides Tony Crescenzi, Tom Keene, took them all to the beach.
Alan Meltzer 101. It's almost as thick as Crescenzi's classic money market.
I checked myself and had an adult moment and did not make fun of that.
What Tony says are so important, and it alludes to Jackson Hole the next hour with Henrietta, which is this is an international meeting, and everybody's looking at the very young Bank of England, its independence, the young Bank of England, where they love to send. I believe Catherine Mann will be at Jackson Hole.
Okay.
Are we going to get that independent mind, such as Professor Mann of Tufts, Brandeis? I believe Brandeis. Are we going to get a Catherine Mann tone at the meeting and in the future from our presidents and governors to put the Treasury Secretary in his place?
Tony, let me ask you about the dollar, if I could. So in that interview that the Secretary gave with Sarah Eisen, Tom's old sparring partner now at the Death Star, as he would say, he kind of dismissed concerns about the dollar, dismissed concerns about the market movements that we saw in the aftermath of that intervention on Wednesday. What do you make of what we've seen in the dollar, the strength of the dollar? He said, once again, he maintains the U.S. as a strong dollar policy. How much is this something that you're going to be watching for here as we get to the opening trade on Monday?
Well, if you look at my name, it has a vowel at the end. I'm Italian. Early in the year, I was in Italy. A week after that, I was sitting in my New York office several feet from Mario Draghi, the famous central bank, the famous president of the European Central Bank. And we were talking about the dollar, and there's a lot of questions around that time. You might recall Liberation Day and the swoon in the dollar, the bonds and stocks all fell at the same time, which is rare. And basically, he said, we asked him, and this was a terrible analogy since someone from Italy, we asked him, are we in late innings with the dollar and all the money that flows into it? The soccer analogy, or football would have been better. But anyway, he said, understanding, of course, the U.S. tradition, I said, no, not late innings. And he cited what's in focus at Jackson Hole, the payment system, and the vast amount of securities and other transactions that are continued to be conducted in dollars. And that, plus the depth of the U.S. markets, which will stay high and well above other markets for a long time, and also the unison of markets in that the U.S. has single stock market, whereas, as he said, they envy that in Europe, those who issue have IPOs, for example, in the initial public offerings in the equity markets there. So the focus should be on other things than this attempt to manage interest rates, which is whether or not the U.S. is getting its house in order, but whether or not the dollar will remain the dominant currency used in the payment system. So a lot of that will come out on Friday.
Where I am on this, then it's almost a triangulation of dollar and inflation, all these other narratives we have. We have a boom economy, David. We have an economy, Christina, that's like a banana republic, 5, 6, 7% nominal GDP. And all this architecture of angst, if that nominal GDP comes down, that animal spirit comes down, things become a lot more fragile fast. I don't hear that in third quarter of 2026. Maybe I don't even hear it in fourth quarter, but a lot of the different conversations we have, like with Tiffany Wilding at PIMCO, is what happens when nominal GDP pulls back, almost like the water, the emperor in the water and all that. But the question is, what happens when we slow down, given these bond stresses, these inflation stresses?
We've got about 60 seconds left.
Most dangerous things you could say to Tom.
I know. Okay, I'm taking it down to 30. Faith in the dollar. Is it still durable?
Yes, the dollar. Yeah, I totally 100% agree with Mr. Crescenzi. The dollar, I push aside all the dollar gloom. I will say, looking at the Bloomberg Dollar Index, that it was an ugly week. And if we get follow through to a weaker dollar, you see stress on yen, stress on euro, but far more emerging market. Philippine peso almost hit a 62. That's untenable for the Philippine community.